all. Welcome to the new episode of NRI series. I hope you guys have watched our previous episodes and you're finding them helpful. So, today we are going to touch upon a very sensitive debate: real estate or equity market. So, in countries like Australia and New Zealand, there are many influencers and communities that advocate buying multiple properties and growing the real estate portfolio as a source of passive income. So, what is your view on that?
Okay, good question, Mansi. So it is not just Australia and New Zealand, it's a global debate, I would say. It's always a fight between the real estate and equity. But instead of taking one side, why should we not show our viewers some numbers so that they will appreciate that it is not your opinion or my opinion, because people have opinions and numbers tell you the facts. What say?
Yeah.
Okay, so based on our initial discussion, I have done some number crunching. So for the benefit of our viewers, we will show them some number crunching here. So just let me take you to the numbers now. Okay, so let me focus on the real estate part first. Okay, so let us talk about the real estate part. So based on our initial discussion, I have put on some numbers, Mansi, for your own house in which you are currently staying. And the value of the house when you bought it was zero point 0.7 million Australian dollars, right? And
Yes.
you made a payment of 20% as a down payment, and then you took a loan of 0.56 million Australian dollars. That is what you did. Based on this calculation, currently, based on the interest rate that we discussed, it is 6.8 per annum, and the loan is for 30 years. So you end up paying a monthly EMI of $3,630. That is what is the EMI coming. So finally, you are going to pay the bank the original capital that you have borrowed plus the interest rate. So this figure comes to 1.3 million. That is finally the payment, right? Now consider that you don't stay in this house. Now we are talking of whether you should invest in real estate or you should invest in equity. So for that, we are going to use this as a second home and see how the rent calculations work out for us. So let us say that you put this house out on rent, and the monthly rent you are going to get is 2817. That's about $650 per week. That is the current rate going in your area. So the annual rent you will earn is 33800 Australian dollars. That is what you will earn. So if we just speak in terms of the rate at which the money is working, this amount that you have put in the house is working at 4.83% per annum. In isolation, these figures appear very good, and I am considering that this house is appreciating based on the last 15, 20, 25 years of data. It is appreciating at, say, on an average 5.5% per annum, the value of the house. Of course, this will vary based on the location and so many other factors, but we have averaged out this value to 5.5% per annum. So by the time you have paid off this loan in 30 years and your pockets are empty by around $1.3 million, because the bank took away all that money and gave you the ownership of the house finally, you have left with the ownership of the house and a value of that house at 3.5 million. So that is what is the picture. If you took this house, bought this house, put it on rent, and here we are with the final figures. Now let us compare that if you had the option of not buying this house and doing something else with that money, which as a NRI, I will recommend you to, instead of putting it in a real estate, managing the house and having, there would be other problems, like sometimes you won't have a tenant, sometimes somebody who's staying in the house will break something and all that maintenance, barring that nuisance of managing real estate. What I am saying is that first problem with the left hand side real estate case is it's very, very capital intensive, and most people don't have that kind of money to buy it in cash. So here we are assuming now that you have the original capital of 0.14 million, which was used as a down payment. Now we are not going to use it as a down payment. We are going to outrightly invest it in the stock market and in India with the help of the Findas team. And you are also going to pay 3630, which is your capacity to pay the EMI to the bank. Instead of paying it to the bank, now I am going to tell you to invest in the equity mutual funds SIP, the systematic investment plan. So you invest $3630 per month in the SIP. Now the problem that was happening with this house initially is the cash flow was negative. You are losing $814 per month because the rent was not enough to cover the EMI. So I'm just forgetting this. I'm discounting this particular loss. Assuming that it is compensated by some amount of increase of rent eventually. So we'll not consider this as a loss. Now I have done some calculation here. If this initial down payment was invested with the guidance of Findas team in proper equity mutual funds, what will happen to it after 30 years in the same time that you are paying off the loan? This would grow to 4.2 million in the worst case at 12%, which is very, very easy to achieve in India. So the initial down payment amount, which otherwise you would have given to the builder, worked for you. This money worked for you at 12%, and you managed to create 42 million out of that. And a monthly investment value, which was the monthly cash flow that you were giving as a EMI to the bank, went to the mutual fund SIP, and this would have grown to 12.6 million. So in the end, at the point of 30 years, by the time, suppose your friend invested the money in the same house as a second house and put it on rent and all that, and you did this, you will be sitting on a pile of cash at $16.8 million by the end of 30 years, by the time your friend has paid off her loan. Now, assuming that this situation happens, I'm saying that this is the worst case typically in India, but consider this as the best case for the calculation right now. Then, if you see here, we are just going to see that what is it that if I wanted to make the same amount of money, 16.8 million, through the real estate, then what is the kind of appreciation I need to get on this property? That is what is the real question here. So I have calculated a second scenario where we need the property to appreciate at 11.2% per annum to grow to 16.8 million. Now you will have to tell me that is it possible that the property will grow at 11.2%? I think the viewers will have to decide it. For me, it looks to be a very difficult situation, which is difficult to get, and this could be termed as a best case here, while 12% I'm saying that it is the worst case. But even if that happened, considering that you got the best block in the town and the most prime location, and the house is on high demand and it is growing at 11% plus per annum, the value, the final value that a real estate investor, your friend, will end up is at, if her house appreciated at 5.5%, she will have 2.2 million, because we will have to reduce this amount that she paid to the bank because of the loan. So that has to be reduced. So finally, she is left with 2.2 million here. And if the house, she was lucky enough to get 11.2% appreciation per annum on the house, then it will be 15.5 million. So I would not conclude anything here. I will leave it open to the viewers to conclude which is the best. Some people may still find that real estate is the best investment, and some people may say no, equity looks to be best. Now there are few scenarios, few points I would like to make here in case of real estate. First thing is, if you have a loan on real estate, you are paying it regularly, you have a good job, then there are 2 or 3 risks that you run which you don't run in equity. The first risk is what happens to the EMI if you lose your job. So my question, Mansi, to you is, do people lose their jobs in Australia?
Yeah, depending on what the situation is.
Yeah, there is a possibility. So we assume that somebody who's taken a EMI, a house on loan and paying a EMI, and he loses a job, the bank is not going to spare him. They will still want their money. While in equity, you can just stop investing. So that is one big advantage that you might have in the worst case. Now, another worst case I would discuss is in case the earning member who's paying the EMI dies, untimely death happens, then what happens to the real estate investment? In this case, also, the bank is not going to spare. And if his another family member, counterpart, his spouse is not working, then the situation could be a very bad thing for the family. And if the other person is working, then maybe the EMI can be paid, or else the family would end up losing the house to the bank, because in any case the bank has lent you the money. So this is the problem. In the second case, if the person is investing in equity and there is untimely death in the family, then only the investment will stop, but there is no other impact that will happen, financial impact on the family. So we also have to, when we do the financial planning, when we talk about the long term investment, we also have to consider these worst cases, because if you don't consider these worst cases, you will end up losing a lot of money. Now, based on this calculation, I would like to ask Mansi to give her what is it that you are currently feeling based on the numbers that we crunched. What is your feeling? Given a choice, where would you put your money, in the real
Yeah.
estate or in the equity in India?
When you elaborate with numbers like this, it surely gives us in-depth insight. I think I would be more inclined to put my money towards mutual funds, but for everyone, it's a personal choice. Like you said, you've just put all the numbers in front of them, and it definitely helps everyone to make the right choices.
Yes, that's perfect. We will leave the viewers to make their own decisions. But just to give you another view, I have been myself investing in the Indian equity market for last 19 years. It was in 2005 that I started my first investment. So just to share with our viewers, I have done all this calculation at 12%. But the money that I am making, the real rate of return that I am generating on my money is in excess of 15%. And this is in the time when Indian economy was not in its best shape. Right now, if you looked at India from the Australian side, we are on our verge of becoming a developed country in the next 10-15 years. According to me and the information that I have, and the interactions I have had with all the financial stalwarts in the country, the best time for India is now, for the next 10, 15, 20 years. Based on my own gut feeling, as well as a lot of data that I have access to, I can say that whatever interest or whatever return on investment I have generated in the last 19 years for myself, that return on investment in the next 19 years, I will beat by anywhere between 1 to 2%, or say 3% on the higher side. I can say this with a very, very conservative estimate. Now, if that happens, then this 12% of assumption goes haywire, and a huge amount of money can be made in. Now, in this case, we discuss the numbers. So people there, the investors may not have this kind of money. They might have small chunks of money. There would be people who are making less amount than we took in the example. They probably would not have the option of investing in real estate in the first place. So you can invest in equity mutual funds in India with a very, very small amount, like starting from, if the conversion ratio is 55 rupees for a Australian dollar, then you can just start investing with just $2. This is how low the price of investing in equities is. And with $2, nobody is going to give you a real estate. Even the taste of it is not possible, right? So I hope the numbers have spoken for themselves, and our viewers may get some insights based on our discussion in this episode. And for now, we will, I think, sum it up here and let the viewers decide. because it is their money and it is their life. So they will decide the fate of their money finally, whether to put it in real estate in Australia, live on the cash flow, it might be negative for a few years, and enjoy the passive income, or put that money in India, enjoy the next bull run, which is due for the next 15-20 years, and make merry. Let us see. So
Yep.
that's it for now from my side. So closing remarks, Mansi.
No, surely the numbers have spoken for themselves, like you said. But thank you so much for your knowledge. It's definitely going to help our viewers to make the correct choices.
So I hope viewers are getting value from our episode. So please do subscribe to our channel. Please do share these episodes with your friends and family. And we hope that better sense prevails. Bye bye. Take care. Have an abundant life.
Thank you.